Hi, I'm Fallon Pitts, and welcome to MBANow. The housing market has gotten off to a dynamic start in 2025, and here to discuss current affordability conditions and MBA's forecast is Eddie Seiler, MBA's Associate Vice President of Housing Economics. Eddie, thanks for joining us today.
Thank you, Fallon.
So to start, I know MBA measures current affordability conditions with our PAPI survey. So can you discuss the latest PAPI results and its impact on the housing market?
Yes, for sure. So again, PAPI is, takes our weekly application survey and we look at the purchase applications. So PAPI stands for Purchase Applications Payment Index. And there's really three ingredients that go into this. Number one are interest rates. So unfortunately, interest rates have gone back to close to 7% in our last survey. They were down at 6.2% in September, but they have come back up. Slightly lower than where they were last year, but still, elevated to where they were prior, of course, to 2022. The second ingredient is the size of the application. So we look at the loan size. Loan size is actually moderated, and we're up 1% year on year. House prices have continued to rise, but of course, borrowers may be looking at smaller houses, and so the application amount has only gone up by 1%. Taking those things together, we have a more than a 3.3% increase in the payment amount. However, the third ingredient in PAPI, we look also at people's income. And why do we do that? Because we want to have a real measure. When we say real, nominally we've gone up 3%, but in real terms, relative to income, we want to be able to see the size of the increase. Incomes have been going up at a healthy clip. When we look at the average weekly earnings, the median amount was up 5% from where it was last year. All in all, taking everything together, the PAPI index is slightly down by about 2% from where it was last year. So are we back on the road to recovery? Well, that is difficult to say, but let's just put it in terms of where we were relative to when we started looking at these numbers. So the base numbers come from March of 2012. So we're going to ask, are houses more expensive? Is accessibility more difficult for new home buyers than it was in 2012? And the answer is yes. PAPI is at about 166. What does that mean? It means that houses in real terms, after controlling for income, are 66% more expensive than they were in March of 2012. In some states, Nevada, Idaho in particular, they've increased by 155 to 160% in real terms. In other states, increases have been less. In Connecticut, for instance, the increase is 24%. That's 24% in real terms, and that's one of the lower increases. But in every state, houses have become less affordable over the last decade or so.
Wow, so that's really interesting to know, and it sounds like affordability has been a persisting issue in the housing market. So to build further on that, MBA recently released its updated 2025 economic forecast. Can you discuss a little bit further about our forecast?
Sure. So I think we need to start with interest rates because the PAPI index is very sensitive to interest rates. As we said, the rates were down at 6.2% or so back in September, and in last week's application survey, we were up to about 7%. So our forecast does have interest rates coming down over the year. So there's a few components that go into that. Number one, what is the Fed going to do? So the Fed decreased its short-term rates, the Fed funds rate, by 1 point last year. We are expecting it to moderate these decreases this year. There's a lot of uncertainty out there, and our latest forecast has us coming down by only 1/4 point this year for the Fed funds rate. Longer term rates, the 10-year rate, should come down, and our forecast now has the 10-year rate down to 4.5% by the end of the year. Not much of a decrease, dare I say, but slowly, higher for longer, but slowly coming down. Coming back to the mortgage interest rates, we are forecasting that they will come down to 6.5% in the fourth quarter. So why the bigger decrease in the mortgage rates than in the 10-year rates? They tend to track each other pretty well. The main reason for this, I think, is because the spread between the 10-year and the mortgage rate should narrow. And a few reasons for that. First of all, some of the uncertainty in the market is going away. The Fed has been pretty, prescriptive in what it intends to do with quantitative tightening. And so the good news is that interest rates should come down. The 30-year rate should come down to about 6.5% by the end of the year. Other things that we're looking at in the forecast include, of course, the inflation rate and the unemployment. And we are looking at a relatively soft landing. The unemployment rate should go up slowly. We're looking at 4.3% at the end of this year and going into 4.5% next year. Inflation should continue to come down slowly, and we are looking at 2.6% by the end of the year, still above the Fed's 2% target, but coming down slowly and in the right direction.
Right, so those bring up all great points, and then even going back to mortgage rates when it's coming down to 6.5%. So hopefully with a little bit lower mortgage rates that will spur some additional activity in the housing market. And so Eddie, for my final question, more so near term, the spring home buying season is kicking off in just a few weeks. So can you share your expectations for how the season will go?
Great question, and this is where we can, add a bit more optimism. So the good news is we are expecting that originations will go up this year. So our latest forecast has us coming up to about 2.1 trillion of originations in 2025 versus about 1.8 trillion in 2024. So that's the good news. So why are we optimistic about these things? Well, there's a few reasons. Number one, we talk a lot about the lock-in effect, golden handcuffs, and that means that a lot of people have low interest rates. They've got the 2.75% to 3% interest rates, and they feel locked into their houses, and they're not willing to move if they have to move into a 6.5%, 7% interest rate. Well, life happens, and people do need to move eventually, and people are realizing, that interest rates are not going to be going back down to the 3% range, and so people are starting to move on it. And this is shown by the inventories. Inventories had been around 1.4 million in 2023, and towards the end of 2024, we've seen inventories move up to about 1.8 million. So that's good news. That means there's homes for people to move into. And it's not only existing homes, but also new homes. Builders have really stepped up, and the proportion of sales that are new homes is up to about 16%, and starts are around 1.4 million. So that's the good news. And that means the large cohorts of millennials or older Gen Zs will have homes potentially to buy. So again, we're looking at inventories moving up. We're looking at starts, being at a healthy clip. And we are looking at originations being around $2.1 trillion this year. Now, what does that mean in terms of counts and the number of originations that we can expect to see? We had about under 5.1 million originations last year. This year, we're looking at originations going up to about 5.7 million. So that means there is, a recovery, expected, and we are moving back up to the numbers that we had prior to the boom in 2020 and 2021.
So that sounds like all good news to me. Even though the housing market does remain dynamic, it does sound like we are keeping an eye out for a few things on the horizon. So Eddie, thanks so much for joining us today.
Thank you so much, Fallon.